Thus, it's important that we delve into them and really explore how they're intertwined. For example, as interest rates increase, we would also expect to see an increase in mortgage delinquencies as well.
We determined that we were moderately bearish on the market, yet bullish on the economy. Simply put, we had more faith in the economy than we did the market.
After about 2 months into the semester, it became evident that we needed to revisit our initial outlook given changes in economic trends. The changes in expectations surrounding interest rates, as well as strong currency headwinds, indicated that our current hypothesis on the economy needed to be updated.
We determined that a moderately bearish outlook on both the market and the economy was more applicable, given these changes. The uncertainty of an interest rate hike was a driving factor in our decision to revise.
The final step in our top-down approach is identifying industries which are most poised for growth. We recognize trends such as the integration of technology and finance, which created great opportunities in the fintech industry.
We also identified the Internet of Things movement as a strong driving force behind the semiconductor industry. In the financial sector, we saw a limited downside risk while still capturing on the upside of an interest rate hike in regional banking.
We make sure to place emphasis on industry-specific ratios such as Tier 1 capital and financials and R&D to sales and healthcare. Industry analysis plays an important role in our filtered approach as it helps identify situations that may have otherwise gone overlooked.
We've just given you an abbreviated version of what, and I'm sure all the past student fund managers here can vouch for me when I say this, was a very work-intensive process. The top-down approach allows us to position ourselves in those sectors and industries that we see driving these countries' economies going forward.
This process allows our analysts to create a baseline for the construction of our portfolio, determining what sectors are deep down for value and optimal for growth.
After completing the top-down analysis, we're able to begin the arduous process of constructing our portfolios that will not only maximize our returns, but also mitigate our risk. Now, I would like to invite up Adam and Megan to explain how this is reflected in our growth fund.
To mimic the way that Cafe is structured, we'd like to begin with our growth fund. This portfolio starts from scratch. That means we don't inherit any of the prior class's holdings.
As you will learn, the thought process for this fund is geared towards short-term price appreciation, attracting investors willing to take on slightly more risk.
When we stepped into the cafe, the growth fund was our first exposure to actively managing a portfolio, as this is the first fund that gets fully reallocated.
We created growth fund with a domestic large cap objective, looking to capitalize on returns in 3 to 6 months. When allocating our positions, we thought it was imperative, if not mandatory, that we separate the stock from the company as we search for short-term price appreciation.
Our growth fund is ideal for investors between the ages of 20 and 39 who are willing to take on slightly more risk.
Because of this, we position ourselves to have a weighted beta of 0.91. This may be low for a growth fund, but given with the initial uncertainty in the market, we thought it was wise to lower our systematic risk. Additionally, our fund is diversified with companies with greater upside potential than downside risk.
We are willing to pay a premium for those stocks set to outpace the overall market. Determining which companies are worth paying extra for requires a strict process.
Paired in teams of 2, we were assigned certain sectors as we began searching 2 miles wide and 2 feet deep in order to explore a variety of sectors and industries.
This comprehensive approach allows us to cast a wide net in order to recognize short-term trends as well as determine areas with greater growth potential. One of the many ways we did this was by utilizing the relative rotation graph available on Bloomberg.
This graph charts the momentum of each sector in order to determine where it is in its life cycle. We would like to see our sectors moving from the bottom left to the top right, going from lagging to leading.
Highlighting the consumer discretionary sector displayed in pink, you can see it heading into the leading quadrants.
Conversely, healthcare is weakening, showing a slowdown in growth. We have over and underweighted these sectors respectively.
Shown behind us are the growth sector weights against the S&P 500. Traditionally, these weights represent the sector contribution to the economy. Our confidence in technology, along with its extensive growth opportunities, led us to be overweight in the sector. However, we found no growth prospects within the utility sector, and therefore we led to be underweight in them.
Since the addition of the real estate sector this year, we felt confident allocating into Gaming and Leisure Properties Incorporated, a casino operating company in the U.S. This ensured that we were market weight with the S&P. Once sector allocation has been determined, an analysis of our key growth metrics is our next step.
And we use these metrics to compare companies to their peers and industry average. We calculate relevant market ratios such as price to earnings growth, and EPS growth rate. Price to earnings basically tells us how much we're willing to pay to get $1 back in profit. Western Alliance, for instance, will pay $19.76 to get $1 back in earnings.
Furthermore, against industry leader US Bancorp, we noticed a greater earnings growth rate at 13.89% and an increasing cash flow margin greatly exceeding its competitor. So for these reasons, we could not ignore Western Alliance's attractive fundamentals.
Financial ratios such as interest, coverage ratio, gross profit margin, and cash flow margin are all examples of ratios we would like to see increase over time. On the other hand, PE, price to book, and PE are all examples of ratios we would like to see decrease. To validate these key ratios, we analyze a company's historical trends quarter over quarter and year over year.
So as you came to realize the importance of fundamentals, behaviorals were acknowledged to have a large role in growth investing, as they tend to drive a stock in the short term. We analyzed worldwide news to find anything that will impact their funds, like the headlines highlighted above. So we create 4 daily reports to reflect this information, and most importantly, we attach analyst opinions to see what actions we need to take going forward.
In regards to these reports, 4M does not mean 401. We've attached a few examples in your handouts. Along with behavioral analysis, we calculate our own price targets, as well as formulate our own analyst opinions, and then we compare those to industry professionals. This comparison helps strengthen our outlook in order to make more concrete decisions.
So once we agreed upon a stock, we utilize technical analysis to find an ideal buying point using a moving average, RSI, stochastics, and MACD. RSI helps determine if a company is overbought at level 70 or sold at level 30. Stochastics tells us the same signals, but uses a short and long-term line to see when those cross to execute a trade. MACD illustrates a pickup or decline momentum. And on the board, Facebook shows an oversold scenario for momentum ending a decline.
Before we execute a trade, we always watch the volume-weighted average price, or the VWAP, a real-time data tool we can use in order to time our actions with greater certainty. We also pay close attention to the price at which a dealer is willing to buy and sell at, also known as the bid-ask spread, as this helps us gauge what price we will receive.
After seeing the process we've taken to allocate our growth funds, we wanted to give you the opportunity to take a look at our holdings. For those of you in the back who might find it a little difficult to see the screen, we placed a fact sheet that shows all of our allocations in the folders provided. As we mentioned before, we're overweight in technology and underweight, healthcare. From here, we focus on a company that is a great representation of our growth analysis.
Berry Plastics has been one of the best holdings within our growth fund. They're in the exciting industry of containers and packaging with 3 diversified product lines. Their bread and butter are rigid tops, engineered materials, and flexible packaging, commonly seen in everyday products such as the cup your morning coffee is in.
This company has a holding period yield of 25.77%. Also, they've exceeded all of our requirements on a fundamental and behavioral level, with a large earnings growth rate, a PEG at 1.37, meaning that they have strong growth prospects with relation to their PE ratio, and a reliable trend of increasing cash flows.
Not only are they dominating their current space, but their recent acquisition of Avintiv has allowed them to tap into the nonwoven industry. They're continuously underestimating the amount of cost synergies seen from this acquisition, starting at $50 million and now exceeding $80 million annually.
Through organic growth, Berry is fully equipped to outperform the current market till the year end. With constant earnings growth and increased guidance, we are clearly not alone in believing that they will continue to thrive.
As you can see, they've outperformed their industry as well as sector year to date. So for the reasons that Ryan and I have just stated, Berry Plastics is a basic materials holding that should be within every growth fund.
As you have now seen how fantastic Berry Plastics is, now we would like to serve you Pinnacle Foods.
Pinnacle Foods is a packaged food company specializing in health-conscious segments. These include frozen vegetables and, more recently, gluten-free. Looking at you, Doc.
As you can see on the screen behind me, this consumer staples company's stellar fundamentals blow its industry rival out of the water. Looking at earnings growth, which shows the future profitability of a company, Pinnacle Foods is set to outpace B&G Foods substantially. They have an average EPS growth rate of 14.73% over the next 4 quarters, compared to B&G Foods' minute 1.51%.
On top of their fundamentals, the growth in their gluten-free segments should drive this company, as the industry as a whole is projected to double by 2020.
We've seen a landscape of consolidation within the food manufacturing industry, with over 400 acquisitions in the last year. Pinnacle's niche market segmentation makes them a prime candidate to be bought out in the near future.
And over the course of the semester, we have seen speculation of an opportunity such as this arising, which would benefit us as the price of security would skyrocket. As you can see, we do have a negative return on the stock, but based on the fundamentals and the future growth expectations, how could you not invest in Pinnacle Foods?
Next, we will focus on a company that is heavily driven by behavioral news.
Nordstrom's is a leading fashion retailer whose stock allows us to capitalize on the cyclicality of the retail industry going into quarter four, as this is typically their best performing quarter.
2 quarters ago, this company announced their anniversary sale had done better than expected the same week that they announced their earnings. This caused their inventory to sales ratio to decrease, aiding management's long-term efforts to do so.
In this 1 week alone, a major inflow of positive news led Nordstrom's stock price to appreciate by 21.69%.
We recently purchased this equity prior to their earnings due to the fact that they were able to decrease the inventory to sales ratio, along with the overall increase in consumer spending throughout quarter four.
Considering the cyclicality of the stock, we do not see ourselves holding it through quarter one of 2017. Now, Corey and Kristen will discuss the benefits of our active management strategy.
One of the benefits within our growth strategy is our ability to trade when a situation presents itself. Our active management approach allowed us to pioneer natural resources perfectly.
Ladies and gentlemen, the love we have in this energy company is not only due to their cost reductions or debt management, but also their prime real estate in the Permian Basin in West Texas. It is one of the largest oil-rich locations in the world, helping their efficiency and production rates top all peers. Now, these rates are usually what investors look at in oil drilling company.
With this strong business model, the streets had high expectations for PXD going into earnings, estimating positive EPS for the first time in 5 quarters. This represented a growth rate of 168%, causing us to question the probability of a surprise.
So after listening to past earnings calls, we concluded that this high expectation was just out of reach for Pioneer. So we exited our position, indicated by the green circle, betting us against the 5.36% drawdown. But management, industry professionals cited positive for PXD for the remaining year, so we decided to buy back in after the decline.
To top it off, we were anticipating an OPEC agreement. This caused us to lead through, and we were rewarded when OPEC agreed to cut production by 1.2 million barrels a day last week. We not only saw a rise in oil price, but an 11.15% share appreciation.
This is a great example of our active management strategy being fully utilized to not only preserve our wealth, but seeing exponential growth in the short term. But PXD was a scenario where we sold to limit our downside, but another company, like A.O. Smith, we sold to take profits. They're an electrical equipment provider in the industrial sector, and we'll show you how we use the price chart and technical indicators to make this decision.
AOS is an example where we decided to lock in our gains when all indicators showed that the stock was moving into overbought territory. When RSI crossed a level of 76, we decided it was time to look for growth elsewhere.
Kristen will surely agree when I say that had we not been so proactive with our position, our 31.2% return would have slipped out of our hands. The holding period was simply too captivating for us to not consider turning that market value into cash. But we rewarded our decision when AOS crossed the long-term support line and appreciated by 11.4%.
Time sensitivity is part of our fast-paced environment. Actively overseeing historical data and current performance enables us to forecast new trends with the utmost confidence. So we've given you 2 scenarios where we make a correct decision. Unfortunately, we cannot always be that accurate, as seen in our performance.
As stated earlier, our funds paid at 0.91, which is slightly lower than that of the market and was our goal from the start. We've constructed our portfolio to reach an attractive weighted growth rate of 42.16%, which we are very proud of. Year to date, we have a raw return of 3.24%, while the S&P 500 stands at 8.23%.
Now, although raw return is certainly a measure to be aware of, what truly matters is our risk-adjusted performance, represented by alpha.
We are currently underperforming the market on a risk-adjusted basis by 4.29%, which is obviously not our ideal result, but compared to peers with the same objective, we've stayed competitive in a market filled with uncertainty.
We have clearly had our fair share of rough times this semester. I'd be lying if I told you we were happy with this performance. However, this is exactly what drives us to work even harder going forward.
To wrap up our growth fund, it's important to remember we're looking for stocks with appreciated returns in a short time horizon.
This requires an active management strategy with a higher tolerance of both risk and price volatility. Also, due to our short-term outlook, price reactions moving through earnings season creates volatility that we as investors live and die by.
Though we presented several scenarios where earnings worked in our favor, we also faced many challenges during this extremely volatile earnings season. For all the good that we've illustrated, we've also endured many tough times, reminding us just how hard investing truly is.
As many of the older Cafe alumni know, Managing one portfolio is difficult in and of itself.
Later in the semester, we had the opportunity to do this all over again, but with a value mindset.
This approach encompasses a more long-term vision, as we still hold securities from the previous semester's portfolio.
Value investing is the concept of using both qualitative and quantitative metrics to derive the intrinsic value of an equity.
Additionally, we look for securities that have been beaten